Again, this could be its own subject area, so I'm not going to talk very much about that today. Just raise some quick points where property comes into play, where I'm having conversations with people and potentially ask questions if this is of interest. The main residence nil rate ban is one which interests me a lot. That's whereby potentially an extra £175,000 exemption from inheritance tax is available in respect of a home that has to be closely inherited, which means left to a child or a grandchild. There is a threshold for eligibility, though, which is £2 million. So above that, the amount of the allowance is reduced. So one key planning point from my point of view is to make sure if people have estates that are a little bit over £2 million, potentially take steps to make sure or look to see if they can cap the value of their estates at £2 million to secure full availability. Also not transferring the interest in the home before death, because it has to be closely inherited. Also anti-avoidance aspects which go along with that. But good news with that one, and keeping this £2 million barrier in mind, is there's no 7-year look back on that particular point. So you can actually transfer assets late in life to get below 2 million. If you own property, other property as well, and you're looking to reduce the value of your estate by gifting those, remember a straight forward gift of a property is chargeable to capital gains tax at market value consideration. So whilst you might start a 7-year clock for a potentially exempt transfer, you are likely to trigger a capital gains tax charge. So you have to think about the balance. Are you making a situation worse because properties get a market value uplift if transferred at death? So there's a bit of a balance there. Trust can come into play, though, as it is possible to hold over gains when property is settled into trust. But trusts become a bit of a nightmare with how they sit in the inheritance tax regime because they're immediately chargeable to inheritance tax. So you have to bear in mind what your nil rate band eligibility is, and will there be tax consequences when assets are removed from a trust on 10-year anniversaries. But business property, that really comes into it again with a potential of a commercial property. So you can have scenarios where there are released from inheritance tax for business assets, which are typically at the rate of 50% for assets that are owned individually and used by a person's business, but can be 100% for shares in a trading company, for instance. And so again, you can look at how assets are structured. With partnerships, this can be relevant as well. Are assets on the balance sheet, do they belong to a partnership or to an individual partner?